Hi, my name is Nagaraj Meda, and recently I made a presentation at Globoil Dubai about the oil and oilseed market as well as sugar, and I also spoke about the macro and economy. I'm doing this presentation exclusively for clients of TransGraph and recording and sending it again on 11th May. And before I start the presentation, I am very glad to share with you uh, very glad to share with you the that we have opened our new corporate office in Vasavi Sky City, Hyderabad, called Buddhimati Knowledge Center. Mr. Shivakumar, who is the head of agribusiness at ITC and who is also the vice chairman of ITC Infotech, Mr. Pradeep Chaudhary and Mr. Ashok Parmar, and also the retired executive director, Mr. Athina Jha of Indian Oil Corporation, have graced the occasion and they have inaugurated our office. And we this is a small personal achievement which I want to share with you. Now, if you look at the markets, what we presented in the Global 2023 in September 2023, when the market was at 3692 ringgit, we expected that the prices will from 3692 prices will eventually go towards 4500 and then they will fall eventually. So this particular thing has happened, but during the March 2024 at the POC we thought that the price at 4200 only the price peak is done, but later market actually went we expected 4300 but it went up to 4500 or 4400 plus and then fell sharply. Why is the market falling is mainly because we have to understand that there is a structure of this particular ABC. This is the A, and now we have completed the B wave, and then subsequently there is a C wave decline. So, as understanding this particular, the technical picture is a very important phenomenon, even from the risk management angle. So, this B wave will give you a clear perspective that market is not going to make a new high. So with that is a kind of a risk management tool. So from the risk management point of view, when people will say that, okay, I want to measure value at risk, and somebody says that I don't want to measure value at risk from the risk management angle. Risk management is a there is no panacea risk management tool that is available. Meaning whether it is a price forecast or a fundamental analysis or a technical analysis will not help you to do a comprehensive risk management. You have to do volatility analysis, and each element will give you one particular perspective. So that is why institutionalizing a process-based decision making is very important. And because the number of variables have substantially increased, software is a must. Please do consider taking a trial or a demo of our software, TransRisk, which will help you to institutionalize the risk management process. So after placing a B wave, why will the market go towards the C wave? Let's look at the fundamentals. So Malaysian palm oil production for the year 2023 is expected to be around 19.02 million tons, and it will be flattish to around 18.82 million tons in the year 2024. And Indonesian production is expected to be around 48.15 million tons in 2024, higher from 46.27 million tons. But if you look at this, the key thing is this year-on-year number, even though we are for JS 24, 260,000 tons incremental production year-on-year, and 370,000 tons for OND 2024. So from AMJ number of 11.99 million tons, we are going towards 14.21 million tons, and that is 2.21 million tons increase in July, August, September. So this particular increase is going to put pressure on the market. So even though for the whole year 2024, we are taking only 250,000 tons of incremental production, but most of that is going to come in the JAS and OND. That is why, as we enter into July, you will have more pressure coming from the palm oil production side. And exports, we are expecting the export from Malaysian exports will be around 440,000 tons higher at 16.44 for 24, and around 1.5 million tons lower for Indonesia at 28.12 million tons, which is leading to a higher stock number. So the Malaysian stocks by the month of June 2024 are expected to be around 1.77 million tons. And by JAS, it will improve close to 1.98 million tons. And so we will be mostly seeing that whatever stock number which we have seen for the month of May will be kind of lowest, and from there slowly it will dip up to 2 million tons. So palm fundamental per se, it is a strong market. There is no need to be bearish, but we also have to see from the soya oil perspective. So overall, from the Malindo point of view, that is Malaysia and Indonesia together, by June 2024, we are expecting around 7.2 million tons, around 500,000 tons lower than the last year. So you are not having a significant stock decline, but a stock decline of around 500,000 tons during the year 2024 from the palm oil point of view. But if you look from the soya oil point of view, the US soybean oil dynamics have been going in a very, very different way. So you can see here the D4 RIN credits from almost $550. It has actually it has been falling to around 200 to below $200 per metric ton. This particular steep fall in the RIN prices is happening because of the oversupply of the renewable diesel. So typically in the US market, when there is, say, you are selling diesel into the market in New York or in the eastern side of the United States market, and if you cannot blend it, then you have to buy a RIN credit from a person who has actually blended more than what it was mandated, the mandated 10%. So there was a lot of demand because a lot of people were not able to blend, because in US it's a pipeline market. The logistics happens through pipeline. But once you blend the soya biodiesel or any biodiesel with the diesel, you cannot use the pipeline. That is why you have certain kind of a constraints for blending in certain parts of the region. But today, because in the biodiesel you use only 10%, and so you get a limited RIN credits. In renewable diesel, because it's a B100, which mostly happens in California and that part of the western part of the United States, you have a high RIN availability, which is leading to a decline in this particular RIN credit prices. So that is why in JFM 2024, with the biodiesel cost was $1280 and diesel price was 879, and while the direct margin was minus 400, even after applying RIN credit, the biodiesel margin is still minus 105.3. So with the bearishness in the RIN credit, you will see continue to have a pressure on the CME soybean oil prices. And China is a one big market which is actually supplying the UCO to United States. So the CNF styrene or Olin price in China is around 870, $860, and the UCO price is around 850. So still there is a kind of a $10 negative margin, and so there is some more downside that has to happen to create the margin for the UCO players. And this is an interesting chart because across the world, whether it is in Europe and US, they are encouraging the alternative biofuels usage which has a less CI score, that is carbon index score. So, like for example, for tallow, yellow grease and white grease, the CI indexes score is from 39.82 to 45.5. But for soybean oil, it is very high. That is why for in terms of the carbon credit, the market share of soybean oil has been falling. Like say in the year 2020, we can see that the soybean oil usage was 3.8 million tons in the biodiesel, which was 55% market share out of the total 6.88 million tons of usage. So I did our analyst did a weighted average score, and then 49.76 is the biodiesel CI score. So over a period of time, industry is trying to bring down the CS score and expected to reach 47.25, even though the consumption has increased from 6.88 to 15.01 million tons. The soybean oil market share has actually fallen from 55% to 35%, and it is flat market around 5.25 million tons. So from the year 2023, from 5.39, first time we are going to see a decline of the soybean oil in for the biodiesel usage, for the biodiesel usage, which is keep the markets bearish. Then, if you look from the global soybean point of view, these are the global soybean stocks. In the year 2019, we had 111.38 million tons as a global bean stocks, and year 24 it is around 111 million tons. So almost kind of reaching this particular level. So during this particular time, what was the price of CME and Argentina soybean oil? So the Argentina soybean oil price was around $700. Okay, when you had a higher bean stocks. So it is going to put the pressure in the market. And at that time, point of time, what was the BMD price? BMD price was around, below $600 in the year 2019. So with this kind of a rise in the bean stock from 92 million tons to 111 million tons in the last 2 years, it is going to put pressure on on the market. And so the soybean oil prices are going to be under severe pressure. Now, if you look at the AMJ quarter and the JS quarter for the soybeans, the Argentina crush in AMJ is expected to be around 13.28 million tons for the whole quarter, and around 13.62 million tons for the JS quarter. So as compared to the last year AMJ was 9.4. From there, you are increased to 13.28, and year on year, last year was 6.5. From there, you are actually almost doubling into 13.62 million tons. So because of this sharp increase in the Argentina crush, and the Brazilian crush is also going to be good, and US crush also is going to be reasonably good, considering that the oil revenue share, which is kind of at 38% now, is expected to slowly come down by around to 35, 34, and the meal revenue share is increasing. At CME soya oil futures and CME soya complex futures, many funds are actually buying meal and selling the oil, leading to because the crush margins are already negative, and if the bean prices fall, that is going to create a bearishness for the oil also. And if you look at the consumption market, at the consumption of edible oils in India is going to be healthy at 22.19 million tons, increasing from 21.32, and Europe around 23.49, and then in China around 35.68 million tons. In Europe, because of this particular new sustainability norms, from the year 2025, there is going to be there is going to means you can use the palm oil imported only if it is segregated, meaning the importers have to clearly declare from which piece of land that particular palm oil has originated, and you have to trace that, and the traceability becomes very, very important. So the traceability premium or segregated sustainable palm oil premium is going to be significantly higher, and so we are going to see a kind of a different kind of a pricing in the Europe as compared to others. So if the supply to Europe comes down because of the non-availability of the segregation or traceability, the availability to the other markets could be higher. And in terms of sunflower oil market, also the supply has been quite very good, and we are expecting the sun oil production to be around 1.96 million tons in AMJ in Russia, and around 1.61 million tons in JS. So with good supplies of both Ukraine and Russia, the sun oil exports will continue to be good. But as we move towards the off season, when we opt from the JS onwards, the weather will actually play into picture. But from the AMG and July point of view, that is kind of mainly MJJ market. It is sun oil is a kind of a well supplied market. And in terms of India, we are expecting that the palm oil imports for the year 23-24 for May is around 630, and June also around 630. And July and August, we may see a kind of improvement. Sorry, July and August also will be around 670, 810,000 tons. And the sun oil will be around 280, 270,000 tons. And soya oil will be around 400, 450,000 tons of imports. So because of which we are expecting that the lower stocks, what we have seen in the month of March, have already started improving. And in the month of May 2024, we are above 1,090 or above 1 million tons. So the stocks will be maintained, and we have given a projections for the stocks until September 2024. So based on that, the India will be like they will continue to do good buying at low prices. More good buying might be coming up. But the soybean oil will be highly imported from Argentina. And overall, for the four major oils, we are saying that the soya oil production is increasing by around 3.3 million tons, and sun and palm are kind of flattish, and rapeseed also slightly lower. So the incremental production is mostly coming from the soybean oil, and overall consumption is going to be increasing. And we are saying that the from year 2023, the four major oil stocks are at at 24.14 million tons, and they will be slightly coming down towards 23 million tons, around 1 million ton drop in the stock. That is why we will not see a major bear market, but until May, until July, you will have July, August, you will have a well-supplied market. So overall, for this particular steep fall until the wave A, I think we have completed the wave B, and C should eventually make a new low below the wave A. Wave A low was 3,200, 3,300 ringgit, and we are expecting that that should be coming during July, August timeframe. 3,200, 3,300 should be coming into picture. And in terms of Malaysian FOB, only in the first month market by July or August, prices are expected to fall towards $750 from the current $852. Okay. And the main reason that will be driving this particular bearishness is the Argentina soy oil, where the currently 828 with that kind of a crush numbers, what we are seeing, easily around 125, $150 market can fall. So this can come up to 730 or $700. So 730, $700 means $130 fall, and but palm might fall only by around 90 to $100, maintaining the spread at a very flattish level because of the bullish fundamentals. In terms of CME soy oil, I think the prices will come down up to 38 by August 2024 is our view. But we need to be careful if the soybean prices fall below 1100 towards 1080 or 1100 cents per bushel. We may see even a further decline in the CME soy oil prices. But at this point of time, we are thinking 40 to 38 is a kind of a bottom, which we are expecting. But Argentina is the one which is going to continue to create the pressure. While Argentina will fall, there will not be much decline in the sunflower oil prices. So sunflower oil prices are expected to hold below 880. The currently prices are 840. We may be taking support of 760 to 750. So around $90 fall in sun oil, whereas $130 fall in soya oil, around $100 fall in palm oil is what we are actually expecting. While that is the price outlook for the edible oils, I just want to give a quick overview about the macro picture also, because in the year 2023, we did not have the recession materialized in spite of the higher interest rates. So the US balance sheet has actually fallen from $8.5 trillion to $7.5 trillion. So even though the bond purchases have come down, but overall net liquidity has actually increased by around $320 billion, because the banks had idle money parked in the form of reverse repo. So they started taking their money back and started supplying to the market. And even in the Chinese market also, there was a special bond spending, which has increased from 4.2 trillion yuan in the year 23 to around 4.45 trillion yuan in the year 2024. With this thing, we are expecting that with different kind of crude oil prices, we have made three scenarios for inflation. So the inflation is expected to be around 3.5 to around, in the best case scenario, in September 2024, we will see 2.2%. But most likely, since it is going to take time, there will not be a sharp decline in the interest rate cycle. But will the rates continue to go up? Will they not decrease the rates at all? The answer is also no, mainly because the governments are the biggest sufferers, while the public and businesses are able to cope up with the higher interest rates. The government is the biggest sufferer. In the year 23, the United States government has paid interest payment of $948 billion, which is 19% of their fiscal revenue. So in the year 24, if the interest rates remain same, they have to pay $1,280 billion, which will be 24% of their fiscal revenue, and Europe has to pay $429 billion, which is 10% of their revenue, and government of India has to pay $16 billion, which is 42% of their fiscal revenue. I'm not mentioning this as a percentage of GDP. I'm mentioning this as a percentage of fiscal revenue to get a right perspective. Because governments have the problem, they will be forcing the central banks. They will be forcing the central banks to bring down the rate. So we are expecting the rates will come down, but by in the year 2024, maybe 25 to 50 basis points is the rate decline, and another 100 basis points or 1% interest decline will happen in the year 2025. We're not seeing a sharp decline. And we also have seen, because of this interest rate differential in US, we have currently 5.4% interest rate, but the Japanese interest rates are at plus 0.1% only. So because of which there is a sharp outflow of the money from Japanese to the US bond market. And we have seen that the forex reserves of Brazil, Argentina, Egypt, Pakistan, and Sri Lanka has actually suffered. I want to talk about a bit about how this Argentinian forex results falling is a problem, because last year the official peso rate against the dollar was close to 300 pesos or 360 pesos. Now it is around 850. So the difference between the blue dollar and unofficial rate and official rate has also substantially declined. And because the currency has almost depreciated by 100% from 350 to almost 850, more than 100%, the farmers will not wait, because the difference between the unofficial and official rate also is shrinking and their economy is stabilizing. So their 50 to 50 million, 2 million tons of soybean crop, the farmers will not have any incentive to wait. They will continue to to sell the soybeans in the market. That is also one key takeaway from here. And another takeaway here is that the India and China has been very stable in they have built forex reserves from the January 2022 to the extent of around $32 billion. And so the Chinese demand is will also continue to be good. So with this thing and the interest rates topping out, we are expecting that the dollar index will make a peak of around at around 108, 109 level, and from there it will not fall sharply. It will be mostly a range bound trade between 103 to 108 for most of the time in the next 3 to 4 months. And the Chinese demand also, I want to mention that the year 2023 has seen a 5.2% GDP growth rate, and for the year 2024, IMF has mentioned the growth rate at 4.25%. But TransGraph is expecting that for the year 2024, the Chinese growth rate will touch 5%. It will not be falling towards 4.2%. The main reason is you can see how all the metrics, whether it is PV sales, we have seen 10.5% growth in 23, 22% commercial vehicle sales, of course, after a decline of around minus 6.8 and minus 31% in the last 2 years. The commercial vehicle market is also kind of picking up, and the electric EV is 39.2%. While the real estate sector, where we have seen 6.8% decline in the fixed asset formation for the real estate sector, it is while this is a concern, the other it is well made up with the investments in power, transport, and alternative energy. So that is why we can see the trade balance of China also is kind of $859 in year 2023. That is exports minus imports. So whatever slight decline they are seeing in terms of the local consumption from the real estate sector is well compensated by the exports, and it is also well compensated by the investments in the alternative energy sector. And we can see that in the form of actual imports of the crude oil. So from 10.2 Mbpd in year 23, we have seen 11.5 Mbpd of crude oil imports, and the year 2024 we have seen 11.7 Mbpd. We are expecting, TransGraph is expecting the crude oil imports to be around 11.7 Mbpd. So, and in the actual products demand of the crude oil also, like say, which includes transportation fuels like gasoline and diesel, naphtha, LPG, ethane, and others, we have seen 11% increase in the year 2023. So with this kind of a good demand numbers in terms of the vehicle sales and real estate, except real estate, the transportation sector, formation, and higher imports of around 16.4 Mbpd in crude, demand in China is continues to be good. In terms of the prices, Saudi is playing a very important role by cutting the production. They have brought down the production from the peak of 10.93 Mbpd in October, November, December 2022. They have brought down the production to 9 Mbpd, and they have stabilized the production in the last 4 quarters at 9 Mbpd. So they used to export around 7.5 and produce around close to 11, but now they are exporting. Their exports are in JS 23 last year has fallen to 6.7 Mbpd. Now for JFM, they have increased to 7.36. So the last 2 quarters, they have been increasing the exports, but they have kept the production stagnant. So their stocks, if any, would have actually come down. So they are now, by end of June, they will be reaching in a stage where they will not be able to maintain their exports with 9 Mbpd production. That is why in JS24 we are expecting at least 1 MB increase towards 10 Mbpd for the Saudi. That is why for JS24 we are taking the increase in production from 33.88 to 34.6 for all the OPEC countries, mainly coming from Saudi. So with the AMG24 negative balance of around supply demand balance of minus 2.7 Mbpd, we are expecting that JS and OMD will be going into surplus. So this is going to put pressure on the market, and so we will see kind of a decline in the price. And this was my POC presentation where we expected two scenarios, mostly the alternative scenario because of the geopolitical premiums, where the market went up to around 92, and now kind of it is falling. So we are expecting that this particular B wave in the form of a triangular form has actually completed. So after the impulse, this is a pink color A is done here, and then the B is also done. Now C will make a new low below this particular A. That is why we are expecting the prices to fall towards $79 per barrel by July 2024 in terms of the Brent crude. And even the WTI crude also we are expecting close to 68 to $70 per barrel. So that is the crude oil outlook. And a quick overview about the sugar market. The global sugar market, the global sugar market has actually, has been fallen from 28 cents per pound. They have fallen to 19.7 cents per pound because of very good production in Brazil. The Brazilian production and exports were underestimated, and that is why market was very bullish, which was again kind of given off. So now what is going to happen now? We are expecting a small technical bounce towards 22, but we are expecting this thing more as a X wave structure. So there will be again a decline back towards 17 to 18. The main reason is mainly the global supplies, incremental supply from Thailand as well as from India. Let's now look into details of the fundamentals. So the Brazilian ethanol parity, the ethanol, because ethanol is more profitable, we can see this one, Brazilian sugar to ethanol parity. Sugar is giving a better money than ethanol. Okay, because of which there will be more diversion of cane towards sugar. And and ethanol stocks are also higher at 3.68 billion liters. So because of that, there will be more sugar production, and we are expecting that for 24-25, the Brazilian sugar production will be flattish to around 45.1 million tons. And in India, we have seen that this was the slide which we made in the Global September 2023. So that time we expected around 30.6 million tons of Indian sugar production and around 4.5 million tons towards the ethanol conversion. So both put together close to 35 million tons of the sugar equivalent cane production is what we expected, whereas most of the people were very bearish in the production estimation. So now what has actually happened? Now the final production number is around 34.4, with 2.5 going to ethanol and 31.9 towards the net sugar production. So I think TransGraph is the only agency which was relatively closer to that 34.5, 35 million tons of the production estimation, even in September 2023. Many people have actually, were not accepting that, but we were able to, based on our field estimation and the weather models, we were able to reasonably estimate the production. And for the year 24-25, we are saying that because of the El Nino, the crop, because the sugar is a long tenure crop, we are expecting that the overall acreages will fall from 5.9 million hectares to 5.6 million hectares going into 24-25. And if you see the ethanol production, we are expecting that, close to 12.5% blend. And mostly we are expecting that while the 2.5 million tons is the supply from sugar for ethanol, the 3.9 million tons of maize also will be used, and 2.7 million tons of broken rice also will be used. After the election, we are expecting that the Food Corporation of India will release another zero point 0.7 million tons of old broken rice, because of which we will be able to meet this particular 12.5% blending rate in the gasoline or petrol market, which will be around 6.2 billion liters. So overall, if you look at the major suppliers or major producing regions balance sheet, because the Brazil production will be kind of flattish, but their exports will be healthy at around 36.8 million tons. And Thailand also will be exporting around 4.2 million tons in 23-24, and 24-25, these exports can increase to by 2 million tons. The key thing which will actually put the lid on the prices is the Indian balance sheet. So we have started with the 5 million tons of opening stock, and with a production of 31.9, and with a domestic consumption of 28.8, because we have taken 1.2 million tons of higher domestic consumption, because some of the in the packet form, some of these things go to the neighboring countries like Bangladesh and Nepal. That is why I have taken slightly higher number for consumption. So with the 28.8 million tons of higher domestic consumption and with zero exports, we will be ending up close to 8 million tons of stock in India. So this 8 million tons of stock is going to put the pressure, and the industry is going to request for allowing the exports. So if the Indian exports hit the global market again at 22 level, there will be a resistance for the market. So that is why in short term we are expecting that the prices will go up to 37.50 in terms of the Indian sugar prices. But eventually, as the market realizes that we are going to have 8 million tons post election, until they allow the exports, again we'll see eventually a kind of a supporting our downside market. And in short term, while we are expecting 41.50 in M30 prices, again it will be kind of coming down eventually. So I thank you very much for your time and attention. And I also want to share with you that for our existing price consulting customers, we have launched a additional hour-based billing or a day-based billing for any of your ad hoc research supports or assignments. If you want to do any backward or forward integration assignments, market intelligence, you can discuss with our engagement managers. We will give you a scoping of the proposal. For example, you want to increase the solvent extraction capacity, so you want to find out an alternative source of raw material. So we may do 5 days of work, and then do the billing only for that particular 5 days of work. And we have kept the rate so low, which you will see when you talk to the market. It is only kind of a break-even kind of a pricing, so that you can use our resources in expanding or improving your risk management processes. And please do contact us for any kind of information. We're all there to serve you better. Thank you very much for your time and attention.